So moving along, I wanted to cover this case here. Now, on every webcast, I like to cover at least 1 or 2 frauds just to show people out there what others are willing to do to get an edge in the market. Now, what these guys did was very, very clever. This has to do with the Millennium Global Emerging Credit Fund, which was a credit-focused emerging market hedge fund whose reported assets were $844 million at the time of its October 16, 2008 collapse. Now, this complaint was put in December 1st, just a month ago. What they actually chose to do was quite interesting, and I'd like to point it out. It says, among the fund's many sovereign debt holdings were Nigerian payment adjustment warrants and Uruguayan value recovery rights. I can't think of more exotic securities than that. It's hard to tell what that even is. And they were illiquid and traded on an over-the-counter basis, of course. And these Uruguayan warrants were never traded, so there were no published quotes. Basically, they were worthless. And the Nigerian warrants never traded at a price above $237, so on and so forth. Don't really need to get into the specifics. The point is, when Globop decided to get independent prices for these securities, they went to the brokers that these fund managers recommended. So think about that. These guys say, well, you can ask A and B about those prices. They'll tell you. And of course, that's what Globop went ahead and did, according to this complaint. So the problem is that these fund managers were feeding prices to these so-called independent brokers, which then fed those prices to Globop. So over here, you're getting prices for completely illiquid securities that are so inflated. Now, here's where the audacity comes in again, because this really shocks me. The prices were so inflated that these securities became the most profitable securities in the fund's portfolio. So that should be a red flag right there, because when you've got some kind of securities that no one's ever heard of, that are illiquid, that don't really trade, and they're worth more than anything else in the portfolio, that may be a reason to try to ask more questions and see what's going on. They go around the safeguards that are in place quite easily. I mean, this didn't take too much imagination. And, of course, the investors were hit in the end of this, because you're dealing with a security whose value is overinflated. Chances are you're not going to get that price when you go ahead and sell it. Not only were they inflating the price of these securities, but they're inflating them so much that they were concealing losses from their other holdings. So if you factored in the gains on these securities, the performance of the overall fund was doing a lot better because they pumped the price up that much. Many times in these situations, especially in a hedge fund scenario, the outlook for investors doesn't look all that great, because the chances of recovering assets are usually quite small, if there's a chance at all. Okay, so that's a quick update on this case, still pending. Just wanted to mention it's another interesting twist on how people scheme the system and avoid detection when they perpetrate their fraud.